Today's guest on Around the Coin is Simon Jones. Simon is the CEO and co-founder of Voltz Labs. Voltz is building a marketplace to allow people to trade interest rates. So they're an interest rate swap automated market maker, or AMM. We talked about the world of interest rates, in the fiat traditional finance landscape, and then what's happening currently today in the crypto world. And we branched off in many other areas from there. Simon has a lot of different experiences, ranging both in fintech and in crypto, and we covered a lot of ground. So I hope you enjoy this conversation. I sure did. If you do, please give us a thumbs up or share this podcast wherever you listen to it. Here is Simon Jones. Hey, Simon. So I'm excited to dive in with you more. You're currently running a project called Voltz Lab. Why don't we start there? Would love to learn a little bit more about what you've built so far and what part of the crypto Web3 world gets you most excited.
Sure. Well, obviously, super nice to be here. In terms of Voltz Labs, I think it's often nicer just to start from why do we exist? And we actually, our North Star in many ways is that we want to help DeFi become the financial system for the whole of the world. And in doing so, we want to completely change and improve the lives of billions of people, and finally give people the same kind of financial opportunities in life. And I guess just to lean into that point a little bit more, right? There's a statistic that always surprises me, which is that there's 20% of the world's population still don't even have a bank account. It's about 1.6 billion people. And what we're building in DeFi, or the potential of DeFi, is not just to unbank or to bank the unbanked. It's actually also to give everybody, no matter where you are kind of born in the world, to have the same financial opportunities in life. So it's a incredibly exciting and transformational opportunity. And in terms, and we hold that as our North Star. So then when Arthur and I, Arthur being my co-founder, when we were kind of setting out to try and work out what we wanted to build in this space, there's a very, very clear problem that needed to be solved, which was that the ecosystem, it produces variable rates of return. And at times, those variable rates can actually also be extremely volatile. And clearly, if the ecosystem is variable and volatile, then it's only ever going to be able to serve a very small subset of the world's financial needs. So it's a clear problem that needs to be solved, and we need stability in the ecosystem such that DeFi is synonymous with stability, not with volatility, in order for DeFi to start being able to be capable of serving the world's financial needs. And what we built at Voltz is basically what's described as an interest rate swap AMM, which sounds complicated, but just to abstract away from that, at the most macro level, what it enables is an interest rate swap. It enables you to move from something that is variable to something which is stable, right? And in doing so, we have therefore introduced stability for the first time in DeFi, which, if I come back to this point, and almost sometimes it's better to describe it by analogy, right? Like if you think of DeFi as this massive house that we're trying to build, and we want it to provide everybody in the world we want to have access to this house, right? The foundations of this house before Voltz existed were extremely unstable, right? And with the introduction of an interest rate swap AMM to DeFi for the first time, we are able to make the foundations of this house stable, such that DeFi and this house, to continue with the analogy, is able to frankly meet its full potential. So that's what we've created. We launched on the 1st of June. And we've been growing about 30% a week since. So it's pretty exciting times.
What's an example of an interest rate swap? So if in terms of a person's actual experience of it.
Yeah. So it's basically the way that it works is you trade a rate. So you might have a variable rate of return and you trade that away in exchange for a fixed rate, or vice versa. And what's kind of interesting is well, there's a few points which are probably worth breaking down in there. I think if we look at traditional finance as an example, right? In traditional finance, there's like a cartoonishly large number associated with the volume traded per annum in TradFi interest rate swaps, which is literally a quadrillion a year. It's insane. So if you take the total market cap of crypto, you times that by 1,000 and you trade that every year, right? That's what's happening in TradFi interest rate swaps. But actually what's kind of interesting is if you go to anybody on the street and say, do you know what an interest rate swap is? They're almost certainly going to go like, no. But if you say, do you know what a fixed rate mortgage is? Then actually they're more than likely to say yes. And what they don't realize is in the background, that mortgage is being constructed off the back of super low level capital markets infrastructure, i.e. an interest rate swap, in order to provide them with that product. So it's a very, very low level, right, piece of infrastructure that enables lots and lots and lots of other products to exist, which when we then think about that in the context of DeFi, before Voltz, right, like the use cases of the ecosystem were extremely limited. But now that we have Voltz in the ecosystem as this low level building block, we have massively expanded the potential use cases that the system can serve, such that DeFi can start becoming the financial system for the whole of the world.
And the way it works in traditional finance now, if I take out a 30-year fixed mortgage, is that the bank that I'm getting that mortgage through often then sells that debt or sells that loan to other banks. Is there like a private market behind the scenes that's happening in?
Yeah. So there's your kind of like value chain, so to speak, in traditional finance from like the actual interest rate swap exchange all the way through to that product that you receive. Like there's multiple different participants acting along that value chain. And in part, why the kind of market is so large is that there's so many different use cases for an interest rate swap. And I think it predominantly breaks down into three. So the first is speculation. That is 100% a part of the market in traditional finance and in DeFi today. But alongside that, you also have the kind of two bigger ones, which are kind of number two is risk management. So people kind of trading away, for example, a variable rates liability that they might have on their balance sheet for a fixed rate liability such that they have certainty. But then the third is actually using an interest rate swap to construct products, and that's products for retail, like fixed rate mortgages. It's also products for corporates. So like there's a whole bunch of different structured products that are created off the back of an interest rate swap. But because there is so much utility associated with the instrument, there's so many different use cases for it. You end up with this kind of very rich ecosystem that exists, where actually, yes, a bank might be providing you with a fixed rate mortgage, but the actual mechanics of how that then ends up interacting with an interest rate swap exchange in the background is very complicated with lots of different actors. But what we're doing in DeFi is actually we're frankly democratizing access to that entire ecosystem. We built a system where I can talk about the mechanics, but the way in which we had to build that, you had to very much think about it from a first principles perspective. You can't just copy paste something that works in TradFi into a world where the constraints of DeFi are fundamentally different. So we had to think about it very much from first principles in order to create the market, but then also off the back of creating it, we have basically created a very kind of low level piece of infrastructure that is now open source, that anybody can come in and build on top of and basically reap the benefits of that instrument in order to innovate, or in order to kind of hedge their own risk and to really be their own sovereign individual.
And is the first principles that you boil down to the fact that there's some money, some value, tokens, whatever it is, in some wallet? It could be in a bank account or in a crypto wallet. And when that's moved from one wallet to another, there's a separate contract or an agreement that says, I'm willing to give you this money under these conditions that you'll pay me a small percentage of that back over time. Maybe there's principal, maybe there's interest payments, but there's some agreement. And effectively in the fiat world, that would be legally enforced. And if someone didn't abide by that contract, then there's legal ramifications. They can go to court, but ultimately, like, police will knock at their door with guns if they don't pay their interest payments over a long enough time period. And then there's bankruptcy courts and all those. And then you're thinking about this from first principles operating on chain, like what are the kinds of first principle analysis that you've thought most about?
Yeah, it's a kind of really interesting point, and to kind of go deeper into what you were saying there, in traditional finance, in the kind of the way in which these instruments work, is you essentially have counterparty risk. So I might enter into a swap with you, but I am then at risk of you kind of not being good for your side, i.e., defaulting. At which point there's this entire legal kind of like a set of legal infrastructure that exists in order to essentially tell me what I can do should something go wrong. But in DeFi, you don't have counterparty risk and you don't have legal infrastructure. Instead, you actually have to build systems such that they can't fail in the first place. Like that's when we think about it from first principles perspective, building an exchange where the mechanics of that exchange is structured and the incentives of that exchange are structured so that it doesn't fail, right? Rather than just hoping it doesn't and then having a whole other infrastructure and telling you what to do when it does, right? That's where we had to come at it from a first principles perspective.
Does that mean there is less risk that people can take? I would imagine that unless you can allow people to borrow money, like actually, I'm going to start with 0 and I'm going to end with 1,000 in my bank account and you're trusting me. And like crypto doesn't allow for that. You have to put down at least 100% collateral in order to take a loan, which completely defeats the point of the loan. Is that a major obstacle, or do you see a pathway forward on that?
Yeah, it's I didn't know you were going to ask this, but I'm excited that you have. And part of the reason for that is actually, I think it was 2 weeks ago, somebody bought a house on OpenSea as an NFT for the first time. So someone has now used like essentially digital asset infrastructure to buy the ownership of a house. And the next step for the ecosystem is not just to have the transfer of the ownership on chain, but actually to finance it on chain. So there is a kind of very kind of well-known point, which is that in DeFi, you have to over collateralize in order to borrow. But if you are able to put down collateral as kind of your home, for example, the digital representation of the ownership of your home, which is the same as what's happening in traditional finance, right? And then you're able to borrow against that. Then actually all of a sudden this kind of like so-called over collateralization issue, right, that you have in DeFi suddenly starts to go away. And where Voltz plays into that, and just coming back to this point around the ecosystem historically being extremely variable and volatile before Voltz introduced the option of stability into the ecosystem. Like if we think about it in the context of this example of kind of mortgages, well, is someone going to like put the house as collateral on Aave and borrow against that using a variable loan? Like arguably not, because they're going to be exposed to the kind of variability of the rate. But are they going to do that with a fixed rate of borrowing? Well, like at that point, it's actually akin to what you get in traditional finance, which you'd argue that the utility then of the ecosystem is like much, much higher. And to lean into this a little bit further, what's actually also kind of interesting when we look at rates and different rate markets today, in traditional finance, in order to get a fixed rate of borrowing for your home, you're going to be paying something like 5 to 6%, given kind of the movements that have taken place over the past 3 to 6 months. But actually in DeFi, you can borrow at a fixed rate for 1.5%. So you're talking about a 4x improvement in terms of your cost of borrowing by financing it through DeFi rails rather than by financing it through traditional financial rails.
We got 1.5% is without collateral, without the 100% collateral.
No, so that 1.5% would be through. So the way that Voltz works is that it's simply an exchange for rates. So the rates have to come from somewhere, and the variable rates in this example I'm providing are coming from Aave. So you would have to be borrowing from Aave, at which point you would have to be putting down collateral. But if you could put down a house, i.e., an NFT of your house as collateral, so to speak, such that you could borrow against that, which is akin to what happens in traditional finance,
Yeah.
then actually you're able to finance the entire thing on chain. And if you talk through the flows, you put your NFT down as collateral, you borrow against that through Aave. That's at a variable rate. You clearly don't want to be exposed to variable rate on your mortgage effectively. So you could then use Voltz as an interest rate swap exchange to trade away that variable rate in exchange for fixed. At which point we have effectively got fixed rate mortgages on chain.
So is there just one guy on the internet who has the ability to take low interest rates without collateral because he has a house through an NFT?
Well, there's the first of many, right? I think it's the next step for the industry. I think that type of thing wouldn't have existed. Coming back to Voltz and the importance of stability, someone wouldn't even have thought of wanting to do that before because they don't want to be exposed to a variable rate on Aave. But if you can now fix it because we have stability in the ecosystem, then suddenly those use cases actually become meaningful, right? At which point I'm excited for this stuff to get built. And honestly, over the next kind of like 6 to 12 months, I see this type of stuff happening. At which point we have fixed rate mortgages coming from DeFi. And that's an exciting development.
Do you think the real estate market will be like the major thing that grounds trading, or grounds lending in the crypto world? Like it's so big. I mean, obviously everyone doesn't own a home or own property, but for people who do, it does seem to ground collateral in the real world. Whereas otherwise there's a difficult translation between pricing and reputational risk on chain versus real world, where it cashes in people's lives in the real world. And so housing seems like it's like the thing that could at least bridge us there, and then create the template for people to have ownership and collateral on chain. And then people could do other things. They could put their car, they could put their, guitar, whatever else eventually.
Yeah. So it's really funny, but we actually know someone who bought a car by borrowing on Aave and then fixing their borrowing costs on Voltz. So we've actually already seen, like, if someone in the community, they kind of let us know that we didn't know they're going to do it. But the point there is that you are, like, the door is being opened right now that we have the option for fixed costs of borrowing in DeFi, right? Which is enabled by kind of Voltz existing alongside the building blocks that came before, of course, right? Like it is now an option, and I'm excited for kind of people to start buying their homes, financing it from DeFi, and actually what's arguably going to be one of the kind of like accelerators for that is the difference in rates that you pay. If you can pay 1.5% financing it from DeFi, you pay 6% financing it from traditional finance, you've got a 4x improvement. And that's pretty exciting.
Yeah, it's huge. Anyway, just to make sure I understand this. So the person who bought the car, they put the price of the car, say it was a $20,000 car.
So they didn't have like an NFT representing the ownership of that car, right? So this particular person, they already had collateral on Aave, but they had unused borrowing capacity. So they then actually messaged us saying, hey, I've just used some of my unused borrowing capacity, which they already had on Aave. I fixed it by 5 volts, right? So I've now got fixed cost of borrowing. I use it to finance my car because it's cheaper than getting financing from traditional finance.
I see. And so they use the money that they pulled out of Aave, the loan, to and so when they go to Voltz turns a variable interest rate into a fixed interest rate. How does that work? So if I have $1,000 on Aave, it's variable, meaning it could go from 2 to 20% interest rate. If it were to be at 20% today, and then I take a fixed interest rate at Voltz, and that interest rate is 20% or 10%, and then it drops down to 2, how does the mechanics work to enable that stability?
Yeah, so you kind of have, it's almost like a 3-sided marketplace. You've got liquidity providers that enable the market to exist in the first place. And then on one side, you've got what we describe as fixed takers, where they're selling a variable rate in exchange for fixed rate. And on the other, you have what we describe as variable takers. In traditional finance, they describe it as floating. But the acronym is kind of, you ended up with FT and FT, which is terrible. I mean, but what they're doing is they are selling a fixed rate in exchange for a variable. So you end up with these pools instead of it being peer to peer, which is like traditional finance, counterparty risk,
Right.
you end up with pool to pool, right, exposure, where this kind of side of the market effectively supports this side. And you, in each instance, have to deposit margin in order to trade. And the way in which the system is built so that it can't fail is if the margin of an individual position ever gets below a certain threshold, a liquidator bot can come in and liquidate that position by effectively unwinding it. And that then kind of basically removes this potentially like under collateralized position from the ecosystem, right? Such that you always maintain solvency of one side relative to the other.
So two questions come to mind. First is, you said a liquidator bot can come in.
Yes.
Is there some subjectivity to whether or not they come in? It's not a like mathematical trigger, or is that preset? So it's like if they drop below 80% collateral, then the smart contract liquidator bot will automatically just, or is there some, why did you use the word can?
Yeah, sorry, I actually lost you for a second, but I think I got the main question, which so basically there's a so the margins, there's a module within the architecture described as the margin engine, and what that does is it kind of enables you as a trader to take essentially leverage, but it defines what your minimum margin requirement is. So you can never enter a position by depositing less than that, but you can deposit more, so you can be less effectively in that instance. You'd be less levered. But what happens then is there is a threshold called the liquidation threshold that is below the minimum margin requirement. And if you had a position that was out of the money over a period of time, your margin would effectively be getting consumed because you're paying the other side because you're out of the money on a block by block basis until you hit the liquidation threshold. And at the point that you hit the liquidation threshold, a liquidator bot can trigger an unwind where they take a proportion of your margin as a fee, and they basically unwind your position before the system ended up insolvent. And that mechanic is one of many mechanics that we had to think about to build and create this kind of exchange where the exchange itself cannot fail, right? Like it's not supported by legal infrastructure. It's actually the fundamental mechanics of the exchange are built in a way such that the ecosystem cannot remain insolvent.
So the three pieces to this are the liquidity providers, the people who want variable interest rate and provide stable, and then people who want stable and provide variable. Is the people providing stable interest rates in exchange for variable, are those folks typically like traders and people who are doing this to make money? And then the people who want stable interest rates in exchange for their variable are people who want cars or they want, practical things. Is that how it ends up?
At a very high level, but I think the truth is that the utility of the exchange is extremely like wide. And we see this in traditional finance. And I think if we just take like one good example, imagine you're a CFI organization, you might be promising variable rates to your customers for some sort of deposit and then lending them out at a fixed rate, right? And then when you aggregate that up on your balance sheet, you're basically left with a rate liability, where that rate liability could be a variable rate because you're promising a variable rate on the other side. So actually at that point, you may wish to be a variable taker where you're selling fixed in exchange for variable to net off that variable rate liability. So because like there are, because the exchange and the instrument caters to all sorts of different user groups, you actually end up with this situation where you can have a very rich and diverse set of actors who want to use the exchange, which enables the balance across the ecosystem to exist.
Is there any, I think about the like Great Depression and the banks. I heard a stat, something like 2,300 banks in 1929 to 1931 went bankrupt for effectively having gone insolvent, not having the collateral on hand to give back to people. And this is similar in more sophisticated fashion, 2008, in the banking crisis, where there were these like under collateralized debts packages that were then traded aftermarket. It more complicated than it was in the Great Depression, but ultimately it's like, seems like the same mechanics where there's a over optimistic projection on the ability of the market to provide payments in return for the loans that the CeFi organization, like the bank, is providing. And then when people don't cash those in, when people don't make payments, people get scared, and then they try to withdraw their remaining cash, and then there's none left. So is this inherent to CeFi where there's just always going to be more debt than there is actual assets or actual money on hand? So a bank will loan out $1 million and it only will retain, a small percentage of that.
But I think if there's a point within there that I think is really interesting, actually, which is if we start thinking about DeFi relative to traditional finance, there's a question of like, why do we even need DeFi in the first place? And if we kind of look at traditional finance actually as an ecosystem, I think at the highest level, the issue with traditional finance is that you as an individual, you're fundamentally not in control of your financial life. There are kind of structures in place where these structures are deliberately opaque, such that they favor people with kind of power, such that they have an information advantage. And that means that you're basically not on a level playing field with them, which means that you don't have equal opportunities. It also means that ultimately you end up kind of not really being in control. And I think,
can you give an example of that?
Yeah. So I was going to say, I think a really good example, which is not necessarily the institution level, but is actually a level a bit higher, is if you think about the Fed. The Fed, look what's happened this week. They put rates up again. And I don't even want to get into a debate as whether that was the right or wrong decision. I think the point is, like, what say did you have as an individual? You didn't have a say in that. These things are actually pretty material. And if you kind of bear with me, I can actually kind of highlight it with the story of a friend of mine. So there's a friend of mine, he's called Matty. I actually used to live with him for the best part of 4 years actually here in London. And he didn't do particularly well at university. I think he'd be one of the first people to admit that. But he's like a real hustler, and he managed to hustle his way into an investment bank. First of all, working in the ops department, then he hustled his way onto the trading floor, and then he managed to hustle his way from London to New York, where he then met his girlfriend called Katie. She works in fashion, and the two of them have been looking to buy a house. And they've been basically saving up to the point that they're ready, which they were, and had been out looking at houses. And then kind of all of a sudden the Fed starts raising rates, and all of a sudden they can't afford the property that they wanted. And it has pretty material impacts on them, right? As a couple, they're kind of thinking about having kids, maybe, I don't want to put words in his mouth, but maybe thinking about getting married, right? These, and yet all of a sudden they're put in this position where the house that they, and the life that they thought they were about to be able to have is actually taken away from them, right? And he's on the inside, he works in traditional finance and he doesn't even have control. And like what that means for you as an individual is it means that like the way in which you go about planning your life based on these structures that exist in traditional finance, you could be planning for something, but because you are not in control of your own financial life, right? Like you can be exposed to these massive kind of events that aren't inside your control. And it basically means like, I kind of make a direct comparison to freedom of speech, that you do not have financial freedom in traditional finance, right? Like, and we fight tooth and nail for freedom of speech. And yet we seem to just be willing to accept that we don't have financial freedom. And what DeFi enables, and in part why I think it's just arguably the most transformational development that's ever taken place in finance, is that it enables you to be in control of your financial life, right? It is the direct opposite of TradFi, right? You have, instead of having opaque systems, you have transparent open source systems. Instead of having systems where the people in power are in control, you have systems where actually the user is at the center and the user is provided ownership over these venues such that the user is ultimately in control, right? And instead of having kind of like a system that, because of its opaque nature, is arguably kind of massively exposed to kind of like systemic fragile events like the 2008 global financial crisis, you actually have a system, and Voltz is a great example of this, where the system is more anti-fragile because it has to be built so that it cannot fail in the first place. So DeFi enables you to actually have control over your financial life. And for me, kind of as someone who's kind of now done multiple startups, but coming into this space, it's something which we've really wanted to see built and wanted to see, happen. We want DeFi to become the financial system for the whole of the world. But in order for that to take place, right, and ultimately why we started Voltz is the ecosystem, it cannot remain variable and volatile, right? We had to have stability exist such that DeFi is synonymous with stability, not synonymous with volatility, right? And that's why we created Voltz. And off the back of that, we really do hope a lot of these new products and services get built.
Yeah. A couple of different different directions we could take this. I'm curious to get your just quick feedback on this slight tangent. Is, as you were speaking, I was thinking about why it is the way it is. What you made the point about free speech versus free finances, freedom of speech for freedom of financial control. I tend to think, like, the thought that came through my head was the protocol for language is maintained decentralized. It's maintained in your head. It's maintained in my head. And we cross-reference that when we speak. If you say a word I don't recognize, I might ask you about it, or maybe I'll adopt it, or maybe I'll modify it in some way. But there's also some centralization, like a dictionary, but for the most part, we don't need that. Whereas in banking, you need a centralized ledger to keep track of it. And I tend to think that it's
sorry, can I just check? I don't want to interrupt you, but do you? Why can't I have a decentralized ledger?
Well, this is what I'm saying. You can't have a decentralized ledger in your head the way you can with, I think there's just the amount of precision and sophistication is not, and the amount of implication of it. Like if we disagree on a word, like I say, fragile is a word, and you say, no, it's not. And I say, yes, it is. Well, maybe you don't recognize it and we go on about our day. But if I say I have $500 I want to pay you and you disagree, then there's a higher implication of that misalignment, right? So,
but is this not the power? Like, it's kind of an interesting point. Is this not the power of blockchain technology? This is arguably what is unlocked.
Right. But I think it's fundamentally reliant on the actual technology itself. So it needs the computational power of machines to be able to up level us. Like language was a discovery. It was a invention of sorts, if you could call it that, of human beings to collaborate and use this communication layer. But it had its limitations. It's like we hit the ceiling of that. And the financial fiat world, I view as like, it was the best technological advancement that was possible with the computational power at the time. So centralize all the money. The Fed prints the money, the Fed controls the interest rates. Then you move to a computationally decentralized financial world where it's agreed upon in the protocol itself. So there can be no, it's as objective as it can possibly be.
Yeah.
And that's what makes it work.
Exactly. And whilst I kind of, I think it's really important to highlight the differences between traditional finance and DeFi. And part of the reason is not just some like technology, which is cool, but doesn't actually have any utility. Like the point of highlighting those differences, because like we're able to build a better world, right? And it's not even necessarily like a swipe at traditional finance. Like in many instances, there are, this is not 100% true, but there are many people within that kind of sector who want to do good. But the kind of technology that they had available at the time meant that the structures that got created had these kind of limitations and weaknesses and flaws associated with them, which create these adverse outcomes for people in society. But we got new technology, and we got this new technology enables us to address those limitations. And that's why, like, kind of DeFi, frankly, is able to exist off the back of distributed ledger technology just existing. And like, that's frankly why I think it's one of the most exciting developments that have ever taken place in financial services.
Yeah, probably even more broadly than financial services.
Society. It's the disentanglement of like the financial services sector from the state, right? And that is pretty big.
Yeah, and if you think about that historically, whenever you disentangle the most powerful branch of like control from a centralized state, there tends to be, like, if you look at the separation of church and state, we had to fight a war to go through that. America was like, hey, this is the one thing we're going to fight for, and split off from Britain. And it seems like, to me, I wonder how this forking will happen. And what's if you want to optimize for peace, like, that's one thing. If you want to optimize for quickness or effectiveness, that's another thing. How do you see the branching? How do you see this disentanglement happening in the future? Is it something that ultimately is going to come down to, like, really strong oppositional stances and federal governments clamping down and enforcing it? It's like we're effectively at like a pseudo war state, or do you see it somehow being more peaceful?
Honestly, the answer to that my opinion on the answer to that question changes like all the time. I think DeFi and regulators arguably have, as two separate, like, sector versus set of institutions, have arguably been at war to date. And it's kind of logical in many ways, because DeFi basically makes the regulators obsolete. So you can kind of see why they would want to kind of impose their authority on the ecosystem. I think truthfully, and in terms of my opinion, like, what I think is likely to play out is DeFi arguably has much greater utility in the developing world than it does in the developed today, right? As just speaking literally right now. And I think what is likely to happen is that we are going to end up with decentralized protocols that are used by a lot of the developing world. And then where it kind of has a touch point with kind of the more developed economies like the US, there's going to, my feeling is that there's going to be so much kind of like political pressure and influence that, the protocols that choose to operate in those spaces end up having to comply in some way with some form of regulation. But in order for that to actually take place, what needs to happen is there needs to be some sort of, instead of there being a war, there needs to be some sort of bilateral conversations between people in the industry and the regulators. And I don't, my answer to this always, like I said, it does evolve. I see that as an interim step in order to start really unlocking the power of DeFi, right? Such that it can start serving kind of the global population, right? Where we can have decentralized protocols serving the rest of the world, but then protocols kind of that are touching, say, the US, where those protocols are making deliberate efforts to comply and engage with regulators, such that as a primitive, it can actually be used, right? Because otherwise you're kind of building something which the regulator is going to stop people from actually interacting with. And that, in my mind, is kind of like the interim step. And then what happens beyond that? Hopefully there's no war, but let's see.
Well, it's finding it's so important and interesting to play out. So I think of the banks as being effectively a pseudo arm of the government. They're locked inside with what the government says. So you also have kind of like central, even like Coinbase and any crypto exchanges are going to be less willing to be compliant because less of their DNA is ingrained in centralized bureaucratic personality types and conservative mindsets, but
Yeah.
they still ultimately will comply. And so like, Tornado Cash protocol was recently banned, which is a decentralized, completely open source, encrypted protocol. And it was used for money laundering, and, a lot of money like went to North Korea supposedly. And the US issued a sanction saying no US citizen can use this protocol, which was the first time that happened. And the actual levers that the government used to push that out there was they would say, hey, Coinbase, you have to take this down or else, or
Yeah.
else we're going to come after you. And ultimately it's a threat of like physical violence. Like that's where cash is in. And that's why it's, difficult for people in other countries the US government can't reach into other countries nearly as easily because of the limits of the military. And I find it interesting to play it out to that level, because like when it's peaceful and we're all just talking, you don't think about the actual hard power. But when there's tension and disagreement starts to arise, and especially if you go into like economic recession, then you start to sink deeper down into the levels of power that different teams actually have. And it seems to me that it's somewhat one of the major advantages that team decentralization has is that it's just economically infeasible to prosecute individuals. Like the reason the US government can be effective towards banks and Coinbase is they're centralized. They have an office and a location and a CEO, and they can go after that. But if they were to say to millions of people, hey, we want you to, use the US dollar, and we're not going to allow you to use Bitcoin to make trades, they have to have a way to effectively enforce their executive branch in a decentralized fashion, coming to each person's door. And that just isn't feasible. They can do it one-offs, make examples, but they just can't afford to send 1 million people to 1 million homes to attack 1 million hardware wallets. So I think that's the major advantage that has.
It does. I mean, as soon as you're a centralized entity, then there's a attack vector,
Right.
from a like regulatory perspective. And then Bitcoin at the other extreme is the most decentralized form of currency that frankly will ever exist. Right.
Mm-hmm.
So like it's just impossible for like a regulator to really go after the people that kind of use and consume Bitcoin. But there is a spectrum, and I guess the question then starts to be like, what happens to everything that's in between? And I guess what this is part of one of the challenges of the space, and this is kind of why I think that we might end up with this world where there is like there are decentralized protocols that are kind of used by the vast majority of the world, but when that touches something like the US, teams are going to be forced to find a way to comply with those regulations. Is because if you think about that spectrum, there's a lot of people in the middle of the spectrum, right? And actually, as kind of more people enter the space and more people come in and innovate, you're still going to have like small kind of founding teams or kind of labs entities like what we have, or kind of what is commonly used as like core contributors, where there's an unknown as to what would happen should you kind of try to decentralize, but then ultimately serve US people just using US as an example, US people in a non-compliant way. So that's why I just have a feeling that there might be these two different worlds that get created. But I would also question whether as an interim step, that is a problem, because it enables the ecosystem to continue to grow, and it enables the protocols and the benefits of the ecosystem to be kind of used by like everybody around the world, which is ultimately what we want. We want these kind of transparent, open source pieces of infrastructure to be accessible to everybody, such that everybody can reap the benefits of it.
Yeah. I've often wondered about this sort of re-centralization component to it. So it's like, why isn't there? And maybe there is that I'm not aware of, but there seems like there would be, given all the momentum and technological attention that's going into decentralization, Web3, et cetera, there would be sort of a concerted effort, like let's pool resources together and lobby government to like make advances now, as opposed to just kind of kicking back and we all do our own thing and we're all in different teams and projects and protocols. And the government effectively doesn't have a major resistance point. And I feel like that could be orchestrated through a DAO or a foundation where you have donors, you have a board, and you have collective action that's taken among the community, and use that as a re-centralized push, a push point back onto
against
the Fed.
regulators. Yeah.
Right. Yeah. Because I mean, right now, the real advances countering the regulators are central organizations like Coinbase, fighting the SEC, but it's still pretty one-off. And it's not like, there's not there's no industry. There's like, you see this in like workers unions or auto unions or things where they like pull resources together for their own common incentives.
Yeah. It's an interesting, I don't know, it's just an interesting point because there's kind of the path for a protocol. Like, so the easiest path for a protocol to be able to serve the world is to decentralize as much as possible. At which point it can, at which point the regulations of different regimes, like, as you were saying, the influence of those regulators is massively reduced because, like, who is it that they're going to go after? So that as the path has been like the predominant path that protocols have gone down, or the kind of people that create kind of new primitives have gone down that path. I think some of the Tornado Cash is, this is going to be interesting to see how it kind of plays out, because writing code is, you're talking about freedom of speech earlier and like financial freedom, writing code is the equivalent to talking, and what is happening there is arguably invading on somebody's rights to freedom of speech. But if just to the extreme that he were to get prosecuted, then it sets a kind of very dangerous precedent for people kind of looking to create protocols and then follow that aggressive decentralization route, because there's still somebody that wrote the initial code. At which point maybe something like what you're suggesting becomes, a more predominant path where the original kind of creators of like version 1 or whatever you want to call it, there's a greater incentive to engage with regulators and either push back or find ways to have sensible regulation, right? And I think that's also one of the issues, which is that almost by definition, in fact, it's not even almost by definition, literally by definition, regulation lags innovation. It just has to, right? You have to have people that innovate, and then you have to have regulators that think, oh, like now there's this new thing that exists. What are the flaws associated with it that can only be solved through regulation? Because I don't think all regulation is bad. And I don't want to go off on a tangent with this, but like just a really obvious example is just kind of road regulation on roads. Imagine New York without any like road regulations. Like the whole thing would just break, right? And if you kind of play that out on a wider scale, you'd have way more deaths, you'd have way more car accidents. So like regulation and rules it has the opportunity to move society to a better equilibrium. But I think what is happening right now, and unfortunately, particularly from the US, is there is kind of relatively draconian kind of enforcement of old regulation to new innovation, which just doesn't make it. Those two things shouldn't be at all compatible with one another, right? Like if you've got a new type of innovation, then it needs new regulation. But unfortunately, I think one of the only ways in which we're actually going to get there, right, is if there starts being some sort of bilateral kind of conversations. And frankly, as a team, we're one of the teams which is, I think, kind of most kind of keen to actually start kind of making these types or engaging in these types of conversations. So there needs to be bilateral engagement between kind of people building the space and regulators, such that if regulation is going to be created and introduced in some shape or form, it's actually sensible regulation that's beneficial, not just application of the old rules to something new, which just doesn't make any sense.
Yeah. And are you guys active in the UK with any sort of?
We're not active in the UK. The reason I kind of mention this is so as a team, we have obviously built kind of like very much a 0 to 1 innovation in the space. And like I was saying at the beginning, we've been growing 30% a week since we launched. So there's there's kind of very clear evidence that there is a need for this type of primitive. I mean, it is a kind of core pillar of traditional finance. It didn't exist in DeFi. So it's relatively logical that it should exist, and it creates the opportunity for stability across the ecosystem. But at the moment, whilst there's aspects of the protocol that are decentralized, like the community actually voted to deploy the contracts, there's still some touch points which are centralized, such as the front end, right, which is still controlled by the labs team. And what we do as a result is we actually just completely block the US because of the regulatory environment in the US. And then that's a shame. We don't want that to be the case. So, there's two routes. You either decentralize, but there probably wouldn't be a front end. There'd just be a protocol and people can interact with that, which is good. And it's a massive step forward relative to what we have in traditional finance today. But actually, we also want an interface to exist. And there needs to therefore be some sort of engagement with the regulators to try and come up with a sensible way to start regulating this innovation. And that's where, as a team, we are in many ways starting to engage on that, which I think is something which other teams either are or kind of aren't publicly talking about.
We were talking about all sorts of things, regulation prior to that, the market, the likelihood of war, and how decentralization and centralization in the fiat world are going to intersect. What has inspired you the most? Are you following certain people online? Are there any particular books or sources where you're paying most attention to learn and stay up on what's happening?
Yeah, there's actually another part to that question, which for me personally is kind of like, why on earth am I in finance in the first place? Mm-hmm. I can promise you that was not the original plan. And actually, I need to take it all the way back to 2009. I was actually a relatively young man, certainly younger than I am today, playing rugby out in Australia. And I wasn't really getting paid much money. So I was out trying to get a job. And I kind of remember just going down the high street from restaurant to cafe to shop, and no one was hiring. And there's this point that I kind of remember relatively vividly where I was sat at home on like a Friday night. I was living in Sydney. All of my friends had gone to Melbourne for the weekend, which I couldn't afford to do because I didn't have a job. And I sat there feeling a little bit sorry for myself with this giant bag of like $1 pasta that I bought from the co-op. And I was eating this with like no sauce, just, like really kind of like no money kind of lifestyle. I just remember thinking, I need to do something about this. And that's the point where I really started researching kind of what was going on in more detail. And it wasn't just me that couldn't get work. There was millions of people that had been made unemployed because it was the middle of the global financial crisis. And you could see it. You could see it on the street. You could, I would just kind of remember the kind of rate of homelessness, so to speak, like really increasing. I was living in central Sydney. There's a point where I was going to a charity shop to get rid of a bunch of clothes, and I decided just to give it to these homeless people. And this guy, I really remember that he came over, he kind of asked me like very politely, because I gave it to one person of people in the homeless kind of group. He's like, can I have clothes out of this bag too? And I was like, yeah, of course. And he went in, he pulled out this pair of shoes, and he was like holding them above his head, like, finally got a pair of shoes. I finally got a pair of shoes.
Wow.
And this kind of like period of my life, it had an impact where I kind of called the university I was set to go to from Australia to switch from architecture, which is what I was originally going to do with my life. And I switched to economics. And then actually coming out of the other side, I was basically determined to try and make sure that stuff like this didn't happen again, which is why I then went on to set up 3 different financial technology companies. First 2 were more traditional Web 2 businesses. Obviously, this is kind of Web 3 and frankly is the potential to be kind of completely transformational. But across those 3 and including a lot of the investing work that I've done, I've actually now been involved in over $1 billion of value creation. But frankly, what I actually care a lot more about is the consistent theme that threads all 3 is that they have all been focused on democratizing access to financial services, which is when we come back to like our North Star at Voltz and like the reason we exist is because we want to see this stuff built. We want people, no matter where they are kind of born in the world, to have the same financial opportunities in life. And DeFi has the potential to enable that. And it is, like we were saying before, arguably, you know, not just for financial services, actually for society, one of the most transformational things that is ever going to happen. And that's why we're excited to try and build it.
Do you think that this shift to decentralized financial technology will dampen or reduce or eliminate the economic depressions, at least specifically the financial related ones? Like could the 2008 banking crisis, some analogous thing happen in crypto? Obviously, you know, you could say that it happens already with pricing, but it's kind of separate, right? Like it is. It's somewhat right.
So, because I think the thing with so economic cycles happen, right? And I think that's going to continue to take place, right? But kind of what is different now versus 2008 is it's an economic cycle that's been caused of other factors, right? Like, you know, we just had COVID, we've got kind of war in Ukraine. You know, these are the contributing factors that are creating that economic cycle, not the financial services sector being opaque and structured in a way that enables the people in power to extract massive amounts of value and basically push recession onto, and therefore the cost onto everybody else around the world. And obviously that 2008 was a long time ago, but I think what's exciting with DeFi is it not just creates an ecosystem that prevents that type of thing from happening, maybe not entirely, but like it certainly massively reduces it, because you have these open source, transparent protocols where the rules of the system are known to everybody. So if there's something kind of very obviously going wrong, like there's lots of eyeballs that can go in and identify that and prevent it from happening. But not only do we have that kind of replacing infrastructure that kind of exists in the Western world, we actually also have that infrastructure being accessible to anybody, no matter where they are in the world, which enables people in the short term to have choice, right? You've got a choice of the existing financial system where you're not in control versus a decentralized system where you are your own sovereign individual and you're in control of your own financial life. And long term, we hope it displaces the structures that exist around the world.
Me too. Are there any particular people or books or blogs that you pay attention to?
There's two that really still stand out to me. It's Satoshi white paper, of course, right? Like, you know, as somebody at that point in time, kind of having gone through that experience just described, I remember 2013 is actually a bit after it being released. I remember reading it for the first time and just being like, wow, right? Like there's, you know, the ethos of this paper and the ethos of decentralization and creating a decentralized financial system is something which is so exciting. But for me, it's always about the technology. And the truth is, the technology at the time didn't enable you, smart contracts didn't really exist. It didn't enable you to build the entire stack, right? And I think we are now at that inflection point where we actually can build the whole stack. And then the other person has got to be Vitalik, of course. You know, he, I mean, look at Ethereum and where it is today, and the introduction of kind of proper smart contracts such that you can build kind of financial protocols on a decentralized kind of like layer, right? Or kind of basically, you know, kind of on a infrastructure layer that facilitates decentralization, right? You know, that is those two people. I mean, Satoshi is potentially group, no one knows. You know, people that particularly inspired me.
It's awesome. And are you writing or tweeting anything personal you want to throw out there?
Yeah, I write and I tweet pretty regularly. You can find me on Twitter. 0x Simon Jones is my handle. And I typically post a lot of the content that I write on Twitter too.
And what does the 0x refer to?
Well, 0x is
just as
the start of every address on Ethereum starts 0x. So I decided to take that into my Twitter handle too.
Nice. Awesome.
Simon, this is a lot of fun, man. I really enjoyed it. Congrats on all the progress with Voltz Labs. And I hope you guys fulfill the mission in allowing decentralized finance to flourish.
Yeah, no, it's been awesome to be here.
All right. See you, buddy.
Cool. Cheers, Mike. See you.